Bonjour. Bonjour.
Régional, enchanté. Régional. Régional.
En anglais, s'il vous plaît.
Hi, my name is Mélanie Tremblay. I work for the Institut québécois de planification financière. I'm an analyst there. So, welcome.
Hi, I'm Jennifer Rocher. I'm a tax associate at Richter in Montreal and at Olive, the Olive store.
Bonjour, Étienne Dufault. Je suis une mallette à Trois-Rivières en fiscalité.
Hi, my name is Reginald Pierre-Louis. I'm a consultant at Raymond Chabot Grant Thornton.
My name is Sebastian Durand. I'm Raymond Chabot Grant Thornton as a senior consultant.
Good morning, Mr. Légaré. So today, my team composed of Léa Beaufils, Stéphane L'Espérance, and myself, Diana El Bustani, will be discussing your situation, trying to give you all the necessary analysis and recommendations as required. So firstly, I'm going to start with a small overview concerning your situation, just to make sure we are all on the same page. Well, basically, at the moment, you own 100% of the shares of Le Pain du Village. It's a business of the family. It was been established by your father, and you have it now. You're the sole shareholder. Moreover, you have a quite big family. You're married. You have 3 kids. 2 of them are under 18, and Charlotte, she's 21, and she's starting to get interested in the business, and she wants to get involved. So, after going through your situation, we were able to identify 3 main issues that should be discussed by our team today. The first issue is we need to review your personal tax situation. Basically, you've had some troubles with your audit and your taxation during the previous years, and you want an advice of us. The second issue is we need to review the company tax situation as well. And finally, we will take a look and discuss a little bit the succession planning of your company. So, firstly, starting with your personal income. In order to review your personal income situation, we started by your personal income. As we mentioned in the case, you have 3 types of income. Firstly, you have the employment income, rental income that is divided between you and your wife, and you have the dividend income. So what we can propose to you, we believe that you're paying a lot of taxes on the income that you have. So firstly, you need to allocate, knowing that your wife does not work, you need to allocate the entire income, rental income to her, other than taking half of it, knowing that she doesn't have any taxes to pay at the moment. Moreover, concerning the employment income, the salary that you take from the company, it would be a good idea for you to take less salary. This way you'll have more liquidity and will be able to have more dividends from which you will be able to get the dividend tax credits. And moreover, after your wife, she's planning to get back to work after 2 or 3 years, so maybe you can give her a reasonable salary if she can work for you as a secretary or something like that. And finally, we believe that you have a lot of income. You didn't mention that you are contributing anything to RRSP, so we believe that it would be a good idea for you to open an RRSP account and contribute some money to it, which will be deductible from your income, and you'll be paying a lot less taxes. So basically, income splitting and proper strategy will allow you to save some taxes. Moving forward, we look also at the children income. You mentioned that you're giving 2,000 shares to each of your kids when they're 12 years old, and they're getting $2 of dividend on these shares. So basically what we believe happens in this situation is the attribution rule. What happens is the income is attributed to you at the end, and you're gonna be the one paying the taxes on these shares. So we believe this might not be a very good idea at the moment. And what we can suggest to you to do in order to save some money for your children would be to maybe open an RESP account for them. It's a registered education saving plan. Well, basically you are able to contribute maximum $2,500 per year for each of your kids when they're under 18, and the government will match 20% of the amount that you contribute. Moreover, you're not taxed on the income that is earned inside this account. However, the income will be taxed whenever the kids will take out the money from the account, but this will not be really a problem, knowing that the kids will not really have any important income at that moment, so the taxes will not be very high. So, going forward, you talked to us about your rental income. You have a rental property, you're dividing the income between you and your wife. We looked a little bit at your rental income, and we believe that there are some mistakes in this calculation. What are the mistakes? Well, firstly, concerning the maintenance. Concerning the maintenance, you've deducted as an expense the add of windows. And we believe that this expense should be capitalized and not be deducted as an expense. So we took the windows from the maintenance and we added to the adjusted cost base of the building. Moreover, you can deduct the insurance, the property taxes are okay. We believe that the travel fees cannot be deducted, so we removed this amount. And we calculated your CCA, your capital cost allowance, and the amount was calculated in the wrong way. Well, what happened is that you basically, when you calculate your CCA, you took the land and the building. The land cannot be depreciated. The building is the only asset that can be, where you can claim CCA. And moreover, you forgot to take the half-year rule from the building. So we did the right calculation for you. We did the calculation and we come up that your actual CCA that you should have paid for 2012 would be of $12,466. So basically what happens in this situation is that your taxes that you have paid are lower than what you were supposed to pay because you calculated your rental income in the wrong way. So what you're supposed to do at the moment is to amend your taxes return in order to be able to correct these mistakes. So now I'm gonna leave it to my colleague Leah, who will start discussing the company tax situation.
All right, so as you mentioned, you said that you wanted to make Mr. Brodeur Jean, who is a really key employee for you, more involved in the company. You also mentioned talking about a car allowance or either renting a car and then getting these expenses that way. So we looked at both options. The car allowance is non-taxable if you put it on a kilometer base. So the first 5,000 kilometers that is used for business use will be at 53 cents each, a total of $2,650. And then the remainder $10,000 that he's currently using for business use will be at 47 cents, which gives a total of $4,700,000. So the total allowance that you would give him for his car is the $7,350. At the moment, there's the current expenses that he is paying, and if we look at for the business use is 60%, that would be $2,969. For him, the allowance, which is $7,350, is much greater than the $2,969. Therefore, it would be a much better benefit for him, and it is deductible to the company. Moreover, if you look at the rental, the company could deduct the rental payments. They must pay, however, the insurance and the repairs and all that. And the car benefit, there will be a car benefit that will be attributed to Jean. So that is a downside of having a rental. So therefore, we say that he should go with a car allowance. So looking at the current year property, plant, and equipment expenses for the company. Right now, the whole amount is being expensed as salary to the employees. This amount cannot be fully expensed. It has to be capitalized and then depreciated, and TC will be taken upon it. Therefore, income will be increased by $1,550,000. Then if we take CCA on the equipment, which is a Class A at 20%, and using the half-year rule, once it is purchased this year, you would have a CCA for this year of $30,000, which will reduce the company's net income. So income will increase overall with $1,550,000. Now, looking at the grant that the company is taking, this must be deducted from the ACB. Also, when you take the fair market value that less the ACB of $1,250,000 less $140,000, this will give you an amount of $1,146,000. This will increase the income once again, and the CCA plant will have an adjusted CCA at 10%, which gives $114,600, which will decrease income and is attributed as amortization. Now, looking at the total income changes for the company, the taxable income is $228,947. When you add back the property, plant, and equipment of $1,550,000 and the meals and entertainment of $412, this we noticed that you deducted the full amount, but only half of it is deductible. And lastly, you deduct the amortization for the property, plant, and equipment of $144,600. The total income change will be a total increase of $1,634,759. Now, moving on to the succession planning that you have. You said that you wanted to utilize your lifetime capital gain deduction. When you talk about this, you need to consider if the company meets the QSBC status. Now, there are 3 criteria that are needed for this. First of all, 90% of the fair market value of the assets need to be used in generating active business income. Secondly, the shares must be owned for the last 24 months either by you or a related party. And lastly, in those 24 months, 50% of the assets have to be used to generate, the fair market value of the assets have to be used to generate active business income. So right now we're looking at whether or not Le Pain du Village is meeting this criteria. So adding the active assets, we put the accounts receivable, inventory, land, building, production equipment, and office equipment. We did not add the cash as we are being conservative, and we do not know if this amount is used to generate active business income. So the total active assets are $4,031,070, and the total assets divided by the total assets gives only 86%. Therefore, the 90% covenant is not met. Therefore, we should purify in order to be able to meet the criteria. So what is the purpose of purification? We will turn non-active assets into assets used to generate active business income in order to utilize lifetime capital gain deduction of $750,000. So when we try to figure out how much is missing, we only have $198,536 that is missing, which we will take out by selling temporary investments, which are currently aggregate investment income. Therefore, if we sell it at their cost of $198,536, this will trigger a taxable capital gain if you do with the difference between the fair market value and the cost. However, once you're able to use a lifetime capital gain deduction, this is a really small downside to this transaction. Then you will use the proceeds to pay off the accounts payable to make this money be actually used for active business income. Because if you just sell it and then keep the money, it is still considered non-active business income. Therefore, by doing this, the new QSBC status will now be at 90%, and you will be able to utilize your lifetime capital gain deduction. Then therefore, you'll use the $750,000 that is completely tax-free for you. Now, moving on, we will look at the elected transfer price, which Stéphane will go into detail a bit more, but just to do a quick overview, the elected transfer price is determined by either the greater of the fair market value, well, the highest you could put is at the fair market value, or the greater of the boot, which is the non-share consideration received for a transaction, and the lesser of the fair market value of the asset or the tax cost. Now Stéphane will go more into detail for this transaction.
Thank you, Leah. Now looking into the succession planning, you've got 3 major goals you want to achieve. The first is you want to bring in your daughter, who's currently working at the company, into the company. and have her become a shareholder. Equally important is one of your key employees, Jean, is also someone you want to keep on hand. And the way of course, ensuring he wants to stay is also ensuring he can partake in the growth of the company. Now, currently, the company, as I mentioned, looks like this. What we plan on doing is to create a holding company. The holding company is going to be used, as we'll talk about in a bit, to move the current common shares of La Fin du Village there, allowing us to use the ETP in order to utilize the lifetime capital gains deduction, and at the same time, allow us to issue out shares of Holdco to 4 major individuals. Yourself, of course, your wife, who then, of course, can manage to use dividends, given that she's not working right now, progressive income tax rate to be useful. To Charlotte, of course, as mentioned, you want to make sure she takes part in the growth, and of course, to Jean. Now, you mentioned you were also looking into a loan as well, as a method of giving your daughter enough money to buy shares from you personally to get a part in the company. Part of the reason you want to go through the rollover is to first maximize use of the QSBC entirely. While she may have some cash, we're not sure if Jean himself has enough money as well. This would require you to loan combined about $750,000 to 2 individuals entirely, which is a large sum of cash. The second major issue is, in this method, you want to make sure you can maintain or keep all the value of the company that you've worked so hard to build up until now. Currently, you estimate the value of about $2.5 million, and you want to make sure that you retain all of this entirely. Now, going forward through this, as we mentioned about the ETP, we're going to first take the common shares of the Painted Village that you own and roll them into the holding company that we're going to establish under, of course, subsection 85.1. This allows us to create a ETP of 1.2 million. This amount will allow you to make use of lifetime capital gains deduction of 750,000. Thank you. Now, the ETP, as mentioned, is going to be used for the proceeds of disposition, the new ACV of the shares, and the new PUC of the shares. Currently, as mentioned, your ACV of the shares involved is 450,000, the amount that you paid to purchase from your father. At this point in time, at an ETP of 1.2 million, you'll have a capital gain of 750,000. However, because your company meets QSBC status, and because you haven't used any of the lifetime capital gains deduction, that entire amount will be negated. There will be no taxes payable. The ACV of the shares will now be $1.2 million, and you will manage to utilize the entire lifetime capital gains deduction in one shot. Now, having done that, we still have, of course, to make sure that common shares from this new holding company are given to various 4 individuals. But before we do that, we also need to do an 86-1 reorganization of the share capital in the company. The reason for this being is that the company, the new holding company, now owns shares worth $2.5 million. And if you would issue shares to these various individuals automatically, then they would get part of that value, which we want to crystallize. This is why we use the 86-1. It crystallizes the value. It's a share reorganization. Current common shares of the holding company will be exchanged for new redeemable preferred shares. This naturally means that the old common shares will be cancelled out and new common shares will be issued. We want to mention that as we go through this entire process, we assume that no boot will be taken whatsoever. You don't need any money in particular, and you haven't mentioned that as an issue. And taking boot is a very tricky thing. In this case, the maximum boot you can take is equal to your PUC, roughly $10,000. Any amount over that will trigger section 84.1, dividend stripping. Because it will be seen as a method of taking dividends out of the company, or money out of the company, and converting it from what would normally be a dividend into a non-taxable capital gain through the use of lifetime capital gains deduction. Once the shares are reorganized, we'll have crystallized as $2.5 million in total. Now, the new share values in question, assuming the shares you issued of the new holding company roughly around $10,000, say $1 per share per 10,000 shares, because you're taking no boot, the old ACV will equal to the new ACV, and of course the old PUC to the new PUC. Nothing's changed, no boot's been taken. Naturally, because you're not taking any boot, the proceeds of disposition and the proceeds of redemption are nil. So, you've crystallized your value, you've used your lifetime capital gains deduction, and you've triggered no negative tax consequences whatsoever. This is the most important part to us, of course, is when you issue out these new common shares. This allows you to issue out a new ACB and new PUC. Now, because Charlotte doesn't have the large amount of cash on hand, as you mentioned, to invest, you can simply issue out a couple hundred shares to her at $1 per share, and she can manage that 50% of the company. She's now fully invested in the growth of the digital bank. Equally important is Jean, because you need to make sure that he's fully invested in the growth of the company going forward. This 15% will allow him to do so. You mentioned you wanted it between 5 and 15%, and we've opted to go for a higher number. So 30% of the company, get out these 2 individuals, You, however, will retain about 50%. One of the things you'd recommend, of course, once you commit the reorganization is to ensure that these preferred redeemable shares each have attached to each individual share roughly 1 million votes. This is to prevent anyone from, say, issuing out new common shares to make you a minority shareholder. So you have maintaining control of the company going forward. At this point, of course, you're not ready to retire. You still want to be actively involved in the business, and this is an important factor for us to know. As mentioned, you want to make sure Mary, your wife, has 20% of the various shares issued. Part of the reason why is Mary has no income on hand. We talked about this before in terms of rental income and in terms of employing her. But given she's not yet ready to immediately move into the new workforce again, she wishes to stay home with her child for a few more years, giving her 20% of these shares means that dividend payments can be flowed through to her. With the dividend tax credit and lower tax rate in general, progressive tax rates being available to her, what this means is you've now achieved a method of income splitting very effectively and very efficiently. Income is now flowing to your wife at a lower tax bracket than would have been if you had simply issued the shares only to yourself. Now, the major factors we looked at here, of course, have been achieved. You've used lifetime capital gains deduction. You've done this by committing an 85-1 rollover and using an ETP that will allow you to use the entire LCGD available to you at $750,000. Equally important is that the current value of the company is crystallized. All the money, all the work that you've done in the last 20 or so years is perfectly available to you into these redeemable preferred shares. This is yours, period. And as you move forward towards a time that at some point in the future, it's there. Equally important is that Charlotte is now a key shareholder. You wanted to move this business forward to the third generation of the family. Your father started it and owned it, and you, of course, yourself have managed to grow it. Equally important to us was one of the, really thank you for your time. Thank you for coming here, and we will open the floor to any questions.
Okay. You said you can crystallize the LCGD, but when you want to materialize it, do you think you're going to have some problems because you're not dealing at arm's length with the other shareholders?
In terms of the realization of the initial rollover?
Yeah.
Rework?
Yeah.
In which term you mean selling it to your daughter down the line in the future, or which person are you looking to sell the shares to?
The one you have already frozen.
We?
Yes. But if the initial shareholder want to materialize his LCGD, he can't.
No, he still can. If he wants
Can he
to.
have some problem with section 45.1?
In terms of selling the shares immediately, or
In the future, to materialize the crystallized value about LCGD.
well, he's already crystallized it. I'm sorry, I'm having a hard time understanding the question.
Est-ce qu'en français ça irait?
Oui, vas-y, essaye.
Thank you. À propos de la valeur que vous avez cristallisée,
Oui, les
vous
2 points.
bénéficiez de la DGC de 750 000 $. Quand vous allez vendre les actions,
Oui.
est-ce que vous pensez que vous allez pouvoir avoir un problème de 84.1?
Ben,
Robert, un jour, j'imagine qu'il va vouloir vendre les actions.
oui, c'est ça.
Ouais, je veux dire, on pourrait peut-être considérer vendre, disons, à Charlotte les actions, vu que Charlotte va reprendre l'entreprise. Est-ce qu'il pourrait avoir un problème à ce moment-là?
Sorry, in English. If it's essentially on a fair market value, then there could be an issue, naturally. But we want all these transactions to be on fair market value, because to do anything below that amount would naturally cause major issues almost off the bat. Because this is a non-arm's length person, there will be consequences, usually under 69(1), in terms of the fact that it's a family member. So if he wants to sell all these shares in the future, yes, only if he doesn't sell it at fair market value. So long as it's kept as if it was a non-arm's length transaction, it should be okay.
A little question about on your PowerPoint. You said allocate the entire rental income to your wife. Do you think that it could be any attribution rules or something? Because Mary doesn't have the cash, but she will receive all the revenue from all the rental income without paying for it. Because me, Robert, I paid the building, and I'm going to allocate to her all the rental income. Do you think there could be a little problem there?
Naturally, trying to allocate every single dollar, it would be an issue. We want to increase the amount that's currently allocated to her. We try and compensate or back this up by making her more involved specifically in the rental business itself. So she'd be responsible for collecting all the checks, she'd be responsible for dealing with any issues that happen to come up with rental property. It would basically be a job for her in that case. By making her the person who's basically operating the rental building, we should be able to increase the amount that's allocated to her substantially.
On that matter, don't you think there's already a problem with the one she's already getting? Her F part, since if I remember correctly, her husband paid the entire building. So even there, for what she's making right now, should he have declared it in his own fund?
It depends on how extensively involved in business she is.
Well, then shouldn't there be a deduction for salary or something?
That would actually be a very effective method of doing it as well, instead of just allocating the income directly in that fashion. We don't know currently who's doing most of the work when it comes to rental building itself. We know there are travel fees. Given that Mr. Robert is already particularly involved in the current business, we were in the assumption that the person in question who was dealing with the rental property was his wife, that it was her in particular who was dealing with any issues and collecting the checks on a regular basis. Which is why we felt that the allocation was reasonable.
My next question will be for Diana. You talk about the children's income and everything. One of my goals is to learn, well, I want them to learn how to manage money and the value of the money. You suggest to open a RESP for Alexis and Martin, which is a great idea. But I just want to know how is this can help them to learn how to manage their money and not like.
Okay, opening an RSP is not really for this fact, but however, it's a good idea in order to save some money for the children and earn income in a efficient way. However, knowing that the income is attributed to the parent whenever they sell the shares, we believe that the only way they can give the money to their children are by just giving the money and.
Okay. Okay. Well, thanks.